When you look at a thermometer, you basically just expect it to tell you the temperature. Like a clean single number, 72 degrees.
Right, exactly.
Yeah.
Just the facts.
Yeah. It doesn't tell you, hey, it's 72 degrees, but also, there's a 10% chance a hurricane is going to completely wipe out your house tomorrow.
Oh, yeah, because we crave that simplicity. I mean,
Yeah.
we really want our financial metrics to be distinct and categorized, just clean.
But when you step into the world of financial markets, we treat the VIX, the volatility index, like a thermometer for market fear. We just expect that clean reading.
Right, the fear gauge.
Exactly. But the deeper you look into the actual math of option pricing, the more you realize that instrument is, well, it's murky. It's measuring the everyday temperature, sure, but it is also quietly trying to price the hurricane at the exact same time.
Yeah, and that's what we left off with. Last time we looked at this data, we were staring at this massive, unresolved mystery.
Welcome to part 2 of our deep dive series, by the way. Today's mission is to really analyze this huge stack of research and 29 years of daily S&P 500 option data to see if the noise in option pricing is actually hiding a secret signal.
Right, and to quickly recap for you last time, we built the VIX and the SVIX indices entirely from scratch. Same options, same days, totally different math.
Right, so VIX weights those options by 1 over K squared, which heavily overweights deep out of the money puts, the disaster insurance.
Exactly. While SVIX uses flat weighting, it treats all strikes equally. And we saw that at 30 days out, they are practically twins, like 99.8% correlated.
They produce identical results for return prediction, for volatility forecasting, portfolio sizing, all of it.
Yeah, but the one glaring exception was at long horizons. SVIX provides a much cleaner variance signal for forecasting volatility.
Oh, right, the numbers were crazy. At 252 days out, SVIX hit an out-of-sample R-squared of 10%.
And VIX alone managed just 1.2%. Wow. Yeah. So VIX's heavy left tail weighting creates massive statistical noise when you are just trying to predict everyday variance.
Okay, let's unpack this. Because if time breeds uncertainty and that left tail weighting creates noise for variance, we are left with the fundamental question for today. Does that exact same tail weighting create a hidden signal for something else entirely?
And that hidden space living right between the two indexes is what we had to dissect today. We call it the gap.
The gap.
Right. And the fundamental math is actually quite elegant. VIX-squared equals SVX-squared plus the gap.
Okay, so let's visualize that for a second for the listener. If you were to graph this out on a chart, SVIX looks like a neat symmetrical bowl, right? The left side and the right side slope up gently.
Yeah, nice U-shape.
But VIX looks like a slide that shoots way up on the left side because, everyone is clamoring to buy puts to protect their downside.
Exactly. So that literal physical space between the symmetrical bowl of SVIX and the steep left side of VIX, that is the gap. And mathematically, that physical space captures the non-quadratic higher moment component of option pricing.
Wait, the higher moment component?
Yeah, so things like risk-neutral skewness, kurtosis, and tail asymmetry. SVIX is the pure flat-weighted variance, just the baseline movement of the market.
Right.
And VIX captures that exact same baseline, but adds on the extra mass from the left tail panic.
I mean, think of it like buying car insurance. If SVIX is the baseline premium you pay for everyday fender benders, just the normal expected variance of driving, then the gap is the extra premium you pay specifically for total loss driving off a cliff disaster insurance.
That is a perfect way to put it. When the gap is large, crash insurance is incredibly expensive relative to the risk of just a simple fender bender.
Right.
And what's really interesting is how this gap evolves over time. So if you look at options that expire in 30 days, this gap only accounts for 7.2% of the VIX.
Basically nothing.
Yeah. At that point, the two indexes move in lockstep with a 0.92 correlation. But look, 360 days out, a full year, and the gap grows to a whopping 19.6% of the VIX.
That's almost 20%.
Right. And the correlation drops down to 0.81.
So the further out into the future we look, the more the two indexes decouple. The gap gets significantly bigger. I mean, why does it decouple so drastically?
Because time literally allows for the unimaginable. Like a total market collapse is highly unlikely to happen in the next 3 weeks.
Right. Hopefully.
Yeah, exactly. But over the next 12 months, the market demands a much higher premium to insure against that tail risk. The tail risk component grows systematically with maturity.
Which leads us to a pretty bizarre anomaly in the data that we need to talk about. Because 99% of the time, VIX is higher than SVIX.
Right.
The gap is positive. People are paying up for that disaster put insurance. but on 1% of trading days, this entire pricing structure breaks down.
Right. SVIX actually exceeds VIX.
The gap goes negative. Mathematically, I mean, that means the option surface is unusually symmetric. The extreme fear premium just vanishes.
Yes.
And you would assume fear vanishes when the market is booming, but the data point's somewhere entirely different, doesn't it?
It really does. If you look at the 180-day maturity mark, 83% of these rare inversions occurred during identified financial crises.
Wait, during crises, so when the market is actively crashing, the disaster premium vanishes.
I know, it sounds completely backward until you really think about the daily mechanics of a market crash.
Okay, walk me through that.
Well, before a crash, you are paying a huge premium for out-of-the-money puts, the protection against the initial drop.
Because you're scared of what might happen.
Exactly. But once the crash is actively happening, the disaster is no longer a theoretical left-tail event. It is the current reality.
Oh, wow.
Right. Volatility across the board explodes so violently that the fender-bender insurance, the SVIX, catches up to the crash insurance.
Because everything is crashing.
Yes. The surface becomes symmetric because the house is already on fire. Everything is volatile.
That is wild. Now, you have to be careful with the short-term data here, right? Because at 30 days out, only 52% of inversions happen during crises.
Yeah, the short-term inversions are largely just microstructure artifacts. You are looking at weird illiquidity blips in the market, not a true economic signal. The real signal lives in the longer maturities.
Okay, but even looking at the long-term charts, not all crises behave the same way. The data shows the gap spiking dramatically during sudden, violent crashes.
Huge spikes.
Yeah, like during the COVID panic in March 2020, the gap hit 13.1%. During the global financial crisis in 2008, it hit 7.5%, which is well above the normal 7.3% average.
Right.
But I noticed a glaring contradiction in the sources. Wait, the gap actually fell during the dot-com bust? It dropped to 4.4%.
Yeah, it did.
How does crash insurance get cheaper during one of the most famous market crashes in history?
It's a great question. And it's because the dot-com bust was an entirely different breed of crisis. It was not a sudden, violent, overnight liquidity panic like COVID.
Right.
It was a slow-burn bear market. It took months and months of just grinding lower, destroying wealth at a very methodical pace.
But that's by 1,000 cuts.
Exactly. And in a slow-burn market, the baseline variance, the SVIX, stays elevated for a really long time. But investors are not bidding up extreme, instantaneous left-tail insurance because there isn't that sudden shock of the world is ending tomorrow.
Okay.
The higher moments of the option surface are just not uniformly elevated in all crises. The gap shrinks because the panic is distributed, not acute.
Okay, so we have established what the gap physically is, that slide on the left side of the option surface, and how it behaves during different flavors of panic. But the core goal of this entire deep dive series is predicting future excess returns.
Right, the holy grail.
Can we look at the option market today and predict what the stock market will do tomorrow? Because in our first deep dive, VIX won the return prediction horse race.
It did. VIX beat SVIX decisively for return prediction.
So here's where it gets really interesting. If SVIX is pure variance and the gap is pure panic, what happens if we strip out the normal variance entirely?
Right. If we isolate just the price of the crash insurance and use it to predict returns at horizons beyond 60 days.
Does the noise become the signal?
It absolutely obliterates both VIX and SVIX. This is the centerpiece finding of the day.
Hit me with the numbers.
Okay, if you look 126 days out, about 6 months, the gap alone hits an 8.0% out of sample R-squared for predicting returns.
I want to pause and just let that land for you listening right now.
Yeah.
In financial forecasting, an 8% out of sample R-squared is a massive statistical achievement.
Whoa, it's huge. And at 252 days out, it climbs to 8.3%.
Wow.
Yeah, compare this to VIX, which only managed 5.6% at 126 days and 5.1% at 252 days.
And SVX?
SVIX was even lower at 4.3% and 2.6%.
That is incredible. The exact component of the VIX that created statistical noise when forecasting normal variance turns out to be the absolute best signal for predicting long-term stock market returns.
Right.
The gap beats the very indices it is derived from.
And what's fascinating here is what this proves about the market. The data provides empirical proof for a really foundational idea in financial theory.
Oh, okay.
I mean, think about it. Why do you earn a premium in the stock market? Why do equities return more than safe government bonds over the long run?
Traditional finance always taught that you earn that premium because you tolerate daily volatility, right? The bumps in the road.
Exactly. But this connects directly to the disaster risk literature. Researchers like Robert Barro, Xavier Gabaix, Jessica Wachter, they argued something completely different.
Right.
They argued that you earn the equity premium because there is a tiny, non-zero chance that the market literally goes to zero.
Oh, wow.
Yeah. You are insuring the system against catastrophe. Think about a massive pension fund manager. They demand a higher expected return, not because they're worried about the S&P 500 dropping 1% on a random Tuesday.
Yeah, nobody cares about a Tuesday.
Right. They demand that premium because they are holding an asset that could vaporize in a 2008-style meltdown.
Right.
By holding stocks, they are effectively selling disaster insurance to the market.
So if we map that theory back to our metrics, SVIX measures the ordinary variance, the random Tuesdays.
Yes.
And the gap measures how wildly expensive the crash insurance is. The data proves it is the crash insurance pricing, not the ordinary variance, that actually dictates future returns.
Spot on. When the market demands massive compensation to insure against left-tail events, basically when the gap is wide, subsequent market returns tend to be higher.
Because investors are terrified of the cliff, so they demand a huge premium just to stay in the game. Think about what this means for your own portfolio. The premium you earn for bearing market risks isn't about stomaching daily volatility. It's the reward you get for holding the bag on rare, severe disaster.
Right. The equity premium is compensation for tail risk, not variance.
That is profound.
It is.
Yeah.
But we do need to be careful not to discard VIX and SVIX entirely.
Fair point.
Yeah, because if we pivot back to forecasting realized volatility, like just predicting how bouncy the market will be rather than what the actual returns will be, the gap alone is actually quite weak.
Yeah, I saw that. At 21 days out, the gap's predictive power for volatility is only 30.6%, compared to VIX at 36.3%. So the crash insurance alone predicts daily wiggles poorly.
Right. But if we connect this to the bigger picture, they act as puzzle pieces. When you combine SVIX, the pure variance measure, with the gap, the tail risk measure, it crushes everything at long horizons.
Oh, so you are taking the symmetrical bowl and adding the steep left side slide back in, but treating them as distinct signals rather than just mashing them together like the VIX formula does.
Yeah. Exactly. At 252 days out, combining SVIX and the gap achieves a massive 10.1% out-of-sample R-squared for volatility forecasting.
And VIX alone was what, 1.2%?
Yeah, 1.2%. Put the pure variance and the pure tail risk together, and you get an incredibly clear picture. The gap is a complement, not a substitute.
Right.
It adds critical higher moment information that the flat-weighted SVIX just completely misses.
So what does this all mean? I mean, if you were listening to this and digesting an 8.3% predictive R-squared for returns, you are probably ready to open your brokerage app right now and build a trading algorithm.
Right. Buy the market when the gap is wide and sell when it shrinks. The signal seems so clear.
It does.
Well, I have to deliver the friction of reality here.
Oh, no.
Yeah, if you test gap-based portfolio strategies against a simple, basic VIX volatility targeting benchmark, the best gap strategy adds, at absolute best, a microscopic plus 0.012 Sharpe ratio improvement.
Wait, 0.012. Are you kidding me?
No.
You just told me this thing has an 8% predictive R-squared, which is practically a crystal ball in finance, and you're telling me I can't even beat a basic VIX strategy with it.
It's statistically indistinguishable from noise.
Where is all the money going?
It gets eaten by the mechanics of trading. Look, an 8% R-squared is a blockbuster finding for financial theory. It definitively proves the disaster risk hypothesis. But the signal-to-noise ratio is simply too low to survive daily implementation.
So you are dealing with transaction costs, wide bid-ask spreads on deep out-of-the-money options.
Exactly. Daily rebalancing, estimation errors. The predicted return is statistically real, but the band of uncertainty around it on any given day is massively wide.
Right.
The gap tells you something profoundly true about expected returns over the long haul, but not with enough precision to generate alpha in a live, daily traded portfolio.
It is like having a compass that definitely points north, but the needle shakes so violently that by the time you actually adjust your steering wheel, you have hit a tree.
That's exactly it. The most informative signal we have found is also the least actionable.
Which is such a massive irony, but that is the central takeaway for you today. The gap, the difference between VIX and SVIX, is genuinely informative. It isolates the non-quadratic higher moment component of option pricing.
Right.
It reveals the literal engine of the equity premium. Tail risk compensation is the predictive core of the market, but it is not a cheat code for your brokerage account. The precision is just too low.
The theoretical punchline remains pristine, though. The exact information that distinguishes VIX from SVIX is the part that actually predicts returns.
Which tees up the third and final deep dive in this series perfectly.
Yes, it does.
Because think about the implications. If the gap predicts returns, and the VIX formula partially captures that gap through its really clunky 1 over k-squared weighting, can we design a better weighting system?
I mean, the 1 over k-squared formula is basically just an arbitrary mathematical choice devised in the 1990s. Surely with modern computing, we can optimize the exact shape of that curve.
Right, so researchers unleashed machine learning on this exact problem. Instead of using the rigid 1990s math where every option gets treated the same way based on a fixed formula, they used models like elastic nets, B-splines, and functional ridge regression.
Just massive computational power.
Yeah, think of these tools as highly flexible digital clay. The AI can mold and bend the weighting curve however it wants across 25 different moneyness bins, covering the entire option surface over decades of data.
They essentially asked the AI to find the absolute perfect formula to predict the stock market.
And the in-sample results were incredibly seductive.
Oh, they look amazing.
Both tails carried predictive content, right? And surprisingly, out of the money calls, the upside bets were highly informative. The AI bent the digital clay into a shape that hit a 1.76% R-squared, predicting short-term returns, completely crushing the VIX's 0.82%.
It really looked like they had found the holy grail of option pricing.
But out of sample, every single learned kernel fails catastrophically.
It just falls apart.
The machine learning models collapse. The digital clay melts. VIX wins. Simplicity wins. That is the finale of our series coming up next time.
And I will leave you with this final thought to mull over until then. If a mathematically pristine machine learning model trained on decades of granular second-by-second market data fails utterly out of sample against a simple arithmetic formula devised in the 1990s, what does that tell us about the absolute limits of trying to outsmart human panic?
Wow. I mean, we started today talking about a thermometer trying to measure a hurricane. Maybe the lesson isn't that we need a more complicated AI-driven thermometer. Maybe the lesson is that when the hurricane actually hits, the precise temperature simply doesn't matter. We will